Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. European stocks are set for a strong open. Equities seem to shrug off renewed trade tensions as the Fed's Powell keeps the focus on rate cuts. We'll continue to watch French stocks and bond markets as the country's Prime Minister increases his chances of surviving this week's no-confidence vote. Plus, ASML third-quarter bookings beat estimates and LVMH sees an unexpected sales rise as two of Europe's most valuable companies help kick off earnings season.
Well, Anna, all it took was that sprinkling of dovishness, and we've got US futures higher, also higher in Europe. As you say, we had those strong earnings from ASML, LVMH numbers strong as well. And so this expectation of Fed cuts combined with the strong start to earnings season on Wall Street overshadowing the tariff worries at the moment. We've got the two-year yield near its lowest since 2022, 346.60. Are we near an inflection point here? And I've popped in the Aussie dollar here because, of course, it is so trade sensitive, and we're up today 0.4%. The countdown to the opening trade starts right now.
Wednesday the 15th, good morning folks. The lesson from yesterday was that the Fed is more important than cooking oil. But it was a close-run race, to be honest. We saw trade tensions re-emerging, but the Fed, Powell, smooth things over. I thought it was quite close, though, Anna. Cooking oil is important, isn't it?
Yes, and maybe luxury handbags are more important than either of them. We'll come to that in just a moment. Let's stick with the... the guy has other views. Let's stick with the story of yesterday in terms of what we learned from the US session. Because you're right, Guy, there were these two dimensions to it. The Fed pushed stocks higher because we heard a lot of dovish messages. It wasn't just from Powell. He was talking certainly dovishly about the labour market. Perceptions remain on a downward trajectory was what he had to say there. But also from others who were signalling either that there were a couple of rate cuts still to come or that normalisation of rates still had to happen. So lots of dovish messages there. Happy days, stocks go higher. Then we got this comment from President Trump, who'd spent the earlier part of the day saying that things were going to be better on trade. We then heard this comment about cooking oil and this threat against Chinese cooking oil into the United States. Another tariff threat and another tariff whiplash, which seems to be what the markets are having to deal with. But globally, shrugging that off, it seems.
Yeah, in the Asian session as well, stronger.
Yep.
If you look at the poly market odds, 85% chance that 100% tariff increase doesn't go ahead by November the 1st. So the expectation is that Trump is going to chicken out.
The Journal's got a big piece this morning. It's prominent, talking about the fact that the Chinese have basically figured out that the stock market is Trump's Achilles heel. Doesn't want it to go down, can't let it go down. Therefore, actually, you can push him around a little bit.
Yeah, but that's interesting, though, isn't it? Because we had a different conversation in April where actually the stock market was dropping and dropping and dropping, and he wasn't...
Blinking.
There wasn't the taco.
Yeah.
But then the bond markets were spooked. The long end of the bond curve was spooked. And that's what brought... Actually, I've forgotten all the acronyms. Yes, it was NIPPY, wasn't it? And that wasn't an acronym. No, that's right. That was his description, yippee, of what was going on in the bond markets. They got yippee, and that brought Trump back to the table.
Yippee, not yippee. It's an important distinction that you have to make.
Well, perhaps we're learning that there are multiple guardrails on President Trump, but whatever happens, the Chinese seeming to use that to their advantage.
Absolutely. And it's going to be interesting to see how it kind of... I read one note this morning talking about yo-yos. This is basically what we're going to be seeing between now and the APEC conferences. You're going to be seeing kind of on-off in terms of the risk narrative around this trade story, because both sides are going to position for it.
But it doesn't matter as long as the meeting goes ahead. And Jameson Greer, the US trade representative, saying that there is a scheduled time to meet at APEC.
Yeah. Let's talk about France, Lizzy, because we have to factor in some of the positivity around the Fed narrative, perhaps the European stocks, but also the earnings story and also the politics.
Yeah, so the renewed Prime Minister, Sébastien Lecornu, managing seemingly to find a compromise when it comes to suspending the pension reform, and that meaning that they've got the support of the Socialist in the National Assembly, meaning that he should be able to survive any no-confidence votes that come tomorrow morning. Now, no one has a majority when it comes to the National Assembly, but really the Socialists have so much power to swing one of those votes, so it's really a good job for him that it seems that he's got them on the side.
It seems from reading it's not 100% certain that he survives. There are still divisions within the Socialist Party that could come back to bite him, but it does seem more likely that he does survive because of this backtracking on the pensions reform. But it's really interesting. We've talked about this before. On the one hand, in the first instance, that's relief. We saw that in the trading yesterday. Towards the end of the day, yields down, spreads down for France over Germany. That's the relief side of things. Maybe we get a budget. But then you're quickly following that with the other thought, which is at what fiscal cost? And that is where perhaps the bond market will linger for a while.
Yeah, it's interesting because French banks hold, I've made this point before, but they hold less French government debt than Italian and Spanish banks, right? So actually the fiscal cost of suspending the reform maybe not as important for them as just getting the political uncertainty out of the way, having a bit more consumer confidence, business confidence.
How many no-confidence votes are there this week? I'm trying to...
I read two. Yes, I read two.
I'm just not entirely sure when exactly they're going to happen. Do they still go ahead at this point? Do the Socialists kind of... Have they poured cold... I don't know. We'll wait and see what happens for the rest of this week. France has the ability to surprise us at the moment, which is going to be something to watch out for the rest of this week. I can't work out, though, which is the biggest story in Paris this morning.
Yeah, I know. All of them are coming together in Paris, it seems.
There's a lot of French stories. LVMH is going to smash it at the open this morning. I've seen calls as high as 10% this morning. We saw the ADRs rallying really sharply. Surprisingly good numbers. China was surprisingly good. America was okay. Europe and Japan a little bit weaker, but LVMH surprising everybody with a decent set of numbers. Now, the comparables are good this quarter, and they're less good next quarter, but then they get better next year as well.
I'm glad you picked up on that, because I feel like, I'm bringing gloom when there's no point, because the stock is going to go a lot higher. So that's the big story. That's where we should focus. But, yes, there was this line from the CFO saying, beware of the comparables in Q4. They were tough in the first half. They'll be tough again in Q4. So Q3 was the easier one. And what are we celebrating with this really strong expectation for LVMH this morning? A 1% increase in total sales.
And what matters this morning is that China story. It's what's lifting Kering. It's what's lifting Richemont as well when it comes to the ADRs in New York. Hence why you're probably going to see the entire luxury sector.
So China takes me on to ASML, where you are clearly going to see some weakness, and the company there is flagging that weakness next year. It sees a material drop in its China business next year. I can't work out whether ASML is a kind of corporate story or a geopolitical story. Yeah, well, it kind of seems to be both.
Well, some of the suggestions are that the stock goes higher this morning. Not by much, but by a little, which suggests that maybe we're treating it still as a corporate story, because bookings in the third quarter came in better than expected, and the market focus is there. But there's the geopolitics. There's the worry about China, and they're talking about expecting China net sales to decline significantly, which sits awkwardly with a positive share price reaction this morning.
Yeah, and it's such a giant we have to stress every single day. The billions of dollars that are flowing into AI infrastructure, flowing into ASML's coffers here. So that's the positive side of the ledger. It's the tariff story that's on the other side.
How much? I need to work out. I need to do some research on this, and I'm sure somebody out there has probably got a great answer for me. What is the rare earth component that goes into ASML's lithography equipment? Because it seems like one of the key pinch points for the rare earth narrative. Because, yes, some of it goes into chips, but some of it definitely goes into making this kit, which is right at the kind of start of the food chain. And I'm just therefore wondering kind of how many different angles we're going to see this stock being kind of pivoted around as a result of geopolitics and politics.
And I'll be back to where we started this conversation, which was the role of tariffs and the role of the tensions around trade. And John Alter's out with a piece this morning talking about the long lens that the Chinese administration has when it comes to thinking about the levers of power that they can pull, and rare earths being one that they've been aware of for decades and seem increasingly willing to pull these days.
Let's talk about central banks from a different angle. We need to talk about what is happening with the ECB. We'll do that with Melanie De Bono in just a moment. Pantheon Macroeconomics senior European economist. We should talk about France as well. I want to talk about Germany a little bit too. What is going on there? Adam Russ, Deutsche Bank's global head of wealth management and business, is going to be joining us a little bit later. They've got a really interesting report out of family offices. Christian Muller-Glissman, Goldman Sachs, head of asset allocation. That's going to be a conversation you want to tune into, as is the last one we're going to have. Actually, there's another one I should throw in, which is the DHL CEO. We're going to be coming to that in just a moment too. Saad Rahim, Trafigura's chief economist, is in town. It is London Metals Week. He is going to be joining us around the table in the next hour, Lizzie. In terms of what's on the docket for today, we've already had a slew of bank earnings stateside yesterday. We've got some more coming today. Morgan Stanley, Bank of America, JP Morgan yesterday warning about stagflation, and that's seeming to overshadow their stellar set of results. But more of those results expected today. Then from 2:45 p.m, we've got
speaker bonanza for central bankers in D.C. And then at 7 p.m. London time, the Beige Book from the Fed, taking on, of course, a higher profile in the absence of economic data stateside. And then as the government shutdown continues, hence the data absence, it is actually going to be payday for the US military, because it seems like the Trump administration has found a way, a loophole, to get the military paid where other paychecks are not going out. And that's 250,000 federal employees who didn't get a paycheck this week.
Yeah, and I'm reading reports talking about the fact that this could be a record government shutdown. That's what we're heading for. We're talking about November now. There's concerns about whether or not we're actually going to be open for Thanksgiving stateside.
I mean, President Trump didn't like some of the data he was getting when we didn't have a shutdown, so maybe he likes it.
Yeah.
Prefers it.
No numbers? That's good.
Yeah.
OK, what else do you need to know this Wednesday morning? Let's walk you through the story. Stellantis says it will invest $13 billion in the United States over the next 4 years. The carmaker is basically aiming to reinvigorate its American business by boosting vehicle production there by around 50%. It's doing so in order, of course, to curb the impact of tariffs. It's the single largest investment in the company's more than 100-year history. Stellantis hasn't existed that long, but the component parts have been around for a while. A group of French telecom carriers led by Bouygues made a €17 billion offer to buy their rival SFR from billionaire Patrick Drahi's Altice France. The deal will be split amongst the three. The proceeds will be split amongst the three, with Bouygues acquiring around 43% of the assets, while Iliad and Orange split the rest, kind of roughly. The non-binding offer would reduce the French telecoms markets to 3 from 4, which is kind of what's happened here in the UK as well. Apple's Tim Cook is promising to boost investment in China. This despite the tech giant facing significant pressure from the Trump administration to shift production back home. Apple still makes, remember, the bulk of its handsets in China, and the country remains a key market. That said, Bloomberg is reporting that the firm is planning to make its new smart home devices in Vietnam.
Coming up on the programme, as Guy was saying, we will be hearing from the DHL Express CEO, who'll talk trade and global expansion. That global conversation coming to us later in the programme. Plus, LVMH could be a big gainer today after the luxury giant's unexpected sales rise. We've been discussing it. Shares are called sharply higher at the open. CAC futures are now up by more than 2%, partly, no doubt, on the back of LVMH. Up next, markets have heard from Jerome Powell at the Fed, and they're reacting positively. We'll discuss all of that. If you want to get involved in any of these conversations, IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg.
The labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out.
Fed Chair Jerome Powell there speaking pretty dovishly, as were other voices from the Fed. And all that dovish talk, Valerie Teitel, pushed up risk appetite and continues to do so around the globe. Good morning.
Yes, it did. S&P futures flipped into the green. NASDAQ futures also flipped into the green as he was speaking. But essentially, his speech was really just the lack of surprises which led to that equity market excitement. He essentially said in that speech, almost verbatim, that his view on employment and on inflation essentially has not changed since that September meeting. And the market took that as him verifying the dot plot, him verifying market pricing for 2 more cuts for the remainder of the year, one in a few weeks' time in October, the last one in December. He did get asked about what kind of data points he was watching. Remember, this is kind of a focus for market participants in this lack of data. Just what is the Fed looking at? He did mention that while there is no great substitute for CPI, state-level jobless claims are a good data point when it comes to measuring the labor market. And I just thought it would be good just to mark how those state-level jobless claims have acted in the last few weeks. They have steadily risen since mid-September. We're still off the highs of the year that was around 260 back in August, but 233K was Bloomberg's estimate for the state-level jobless claims. Remember, these state-level numbers are still released every Thursday at 1:30. It just takes economists a few more hours to amalgamate all 50 states into a national number. But something to keep in mind that we still get, I guess, a shred of data on the labor market, and this is what Jerome Powell is watching. He did have some words to say about QT. He does want to end balance sheet runoff a bit sooner than the market expected. That did lead to a fixed income rally. But really, yesterday, Guy, was about the rallying gilts on the soft labor market and a rally in OATs. OATs are now down 20 basis points since the highs from that shock resignation on October 6th. And they had one of the best sessions in a month yesterday.
Yeah, it's interesting. Both. I thought the gilt story was really interesting on what Bailey had to say yesterday as well. We'll come back to that maybe a little bit later on. And obviously, we're seeing a little bit of volatility when it comes to the French market. French politics absolutely front and centre. Our next guest recently upgraded her outlook for the French economy. Joining us now, Melanie de Bono, senior European economist at forecasting firm Pantheon Economics. Good morning. Nice to see you.
Nice to see you.
So why have you upgraded your outlook for France? The data's actually all right coming out of France at the moment, despite all the noise we're getting on politics.
Yes, exactly. So we've had some good monthly numbers come in, especially on industrial production. For example, we had a huge jump at the start of the third quarter, and these have fed in through our nowcast models to make us push through with a bump up in our numbers.
So does France actually need a budget at the moment? Like, it seems to be doing all right on its own.
I mean, European countries are used to not having budgets. Yeah. So, I mean, a clear example of this is Spain, where they've been rolling over budgets for years. But for France's case, it's under the clutch, as we say, under the
watch.
The watchful eye of the EU, having, of course, a significantly bigger budget than the EU's budget.
Supposed to be 3%. What is it going to be, do you think, next year?
Well, we've got something closer to 5.5 and then coming up to 6 again if they don't do anything. So they do need to get in some significant tightening, otherwise they're going to continue to be in trouble.
Right. So Melanie, good morning. Sure. So it seems that the markets breathe a sigh of relief when they see some kind of certainty and predictability in a budget maybe qualifies as that, or at least the fact that we won't get rid of the Prime Minister this week qualifies as certainty probably in French politics. So that's fine in the instant, in the first moment. But in the second moment, maybe you start to think, and markets start to think about what's the fiscal cost of backtracking on the pensions narrative. I mean, how does that start to stick to France? Where do we start to see that sort of fear emerge?
Exactly. So at this point, the Prime Minister decided that he would shelve the pension reform, right? So there won't be a pension age increase, at least not until 2027. And that seems to have appeased the Socialists, who will probably support him in the upcoming no-confidence vote. But that's not to say that they'll actually support the full budget that he then presents later on. And so we could be exactly in the same point of losing another Prime Minister, losing a vote of confidence in the budget in just a few days' time. Also, the alternative, so going to an election, doesn't necessarily mean that France will get back on track in terms of its public finances. And therefore, markets right now might be welcoming the stability or thinking that there will be a government in there. However, in the long run, they'll probably again start to think, actually, probably the next government also won't push through the cuts that are needed, and therefore France is still in a bind. OK,
so we watch spreads with that in mind. Let's think about the role of the ECB. Now, I know you don't think the ECB needs to or will step in this particular case around France, but thinking about other things the ECB does, obviously rates, interest rates. We've heard from the Bank de France governor, François Villeroy de Gallo. He's been talking about the next move not being a hike, the next move from the ECB not being a hike, so suggesting it'll be a cut. But then Maclouf saying he's more worried about inflation. Are we closer to a direction for the ECB?
So, in our view, a cut is not coming. So, of course, everybody left the last meeting thinking they're surely not going to cut. And then a few days later, we had even more threats from the tariff side and therefore downside risks to growth. And again, the potential that there could be a cut in December came to light. However, we don't think that the inflation numbers will give the ECB the possibility to do that. So inflation is likely to stay just a touch above 2%. Inflation expectations are broadly stable. There really isn't a need to cut if the focus remains on inflation.
Also quoting from that interview with the French central bank governor, he also said that France needs to make major spending cuts or tax rises in order to get spending in shape. When you're pricing up the options, what's actually affordable on top of suspending the pension reforms if Lecornu needs to make more compromises with the Socialists?
Well, I mean, there's a lot of choices that governments can look at when they want to raise revenue. They can turn towards taxing banks more, such as something, for example, that Italy is currently considering, or they could decide to cut other things, such as maybe spending in other areas where they have in the past continued to spend a lot. And France, unfortunately, has spent quite a lot on a lot of things in recent years. So there are many areas that the Prime Minister could look at and where he could reel in spending cuts. Unfortunately, we don't think that he can do it all in that way, and taxes do have to rise in France.
And you talk about, Anna, the breaking point where the ECB maybe would have to step in and intervene with the oats-bundt spread. You've written, Melanie, about 110 being the level that would force French politicians to really think that the bond vigilantes would step in. But we're not going towards that. We're going down. We're at 78 basis points here. I wonder if you think that actually it's the politicians who are the guardrails here, who are in charge of leading the markets. It's really, everyone seems to have to get in line with what the Socialists want here. And since we've seen this relief in French bonds, do we think it's going to last?
I don't think it's going to last. So we have this stability right now, which, of course, in 2 days' time, when there's another vote of no confidence, could already fall. The spread could already start to increase again. We then have the issue of when a full budget is presented to Parliament, will the Socialists back the Prime Minister? We don't think so. Or at least there's still a question mark over that, because they said that they will only support Lecornu's government if they see strong policies coming in.
So how long do you think this government lasts for, then?
Oh, it could last. We could see a game of chicken where after this, the president is again forced to bring in more prime ministers because he doesn't want the alternative, which is going to an election, which right now the polls would say the far right would most likely win.
Do you think Lecornu will still be Prime Minister by the end of the year? I'd take that as a no.
Nobody knows right now.
But going back to Guy's point on the data and on growth,
yes.
Do you see a resurgence in business and consumer confidence if that instability is the story all the way for another 18 months?
I mean, there's two sides, because, of course, there is maybe this high uncertainty for investment and firms shelving plans, also not just because of what's happening domestically, but also what's happening across the globe. If you've got trade uncertainty so high, because, of course, the U.S. administration is up and down about what they want, even from the EU after having signed a trade deal, they will maybe hold back on certain investment. However, because the ECB has cut rates so significantly over the past year, they're seeing lending rates come down and down and down. And what we're seeing is that lending is going up. So people are taking the opportunity of lower rates and actually borrowing more. So credit will support the
question
economy.
on Germany before we wrap up. Everybody's got very excited about the fact that we're going to get this big fiscal impulse that's coming. It's going to be massive. It's going to be transformative. It's going to change the European economy. Where is it?
Yeah, good question. So the German government has decided they're going to splurge on investment, but they haven't said exactly what they're going to spend it on or how they're going to fund it.
Yeah.
And in our view, it's going to have to be funded by a significant jump in debt. So we've estimated that they'll probably have to issue around 1 trillion over the next decade or so, and that's going to keep German bond yields high. So even if spreads like for Italy and France come down, yields will stay up.
And you think Germany's in a recession?
Yes, we do. Yeah, the industrial production and trade numbers were absolutely horrible in August. And even with a rebound that we expect in certain monthly numbers in September, because, for example, we see leading indicators like on cars are very good for September, that won't be enough. So at least the first print will show a recession, because, of course, we get lots of revisions from Germany.
All right, Melanie, great to have you with us around the desk this morning for the first time. I hope you'll come back soon. Melanie De Bono, Senior Europe Economist over at Pantheon Macroeconomics. We have got the bond market open here in Europe, and the French, the oats-bundt spread at 78 basis points here, given that stability for now in French politics. But coming up, we're going to speak to Adam Russ, Global Head of Wealth Management and Business over at Deutsche Bank, about family offices building war chests in this uncertain global economy. That conversation next. This is Bloomberg.
Good morning. Wednesday morning, what is it, 15th of October. In terms of what we saw yesterday in equities, it was a really lumpy, bumpy session. We were trying to work out which was more important, the Fed or cooking oil. In terms of who was the winner in that process, I think we now have a clear winner. It was the Fed. Cooking oil coming a distant second. As you can see, equity markets are on the front foot this morning. We've also got some really strong corporate news out of France in particular. LVMH looks like it's going to have a cracking start to the day. ASML might be up a little.
Yes, and in bond markets, we managed to factor in quite a lot of the political developments of yesterday into the bond markets before they really closed out for the day. And so we saw the French 10-year, down 7 basis points in yesterday's session, and a bit of that continues today, but not quite so much. So we're down just 1.8 basis points over on the French 10-year. As Lizzie was saying just before the break, the spread is a little bit narrower. We're at 78 basis points, which is kind of almost where we were yesterday, but not getting any worse, certainly.
Well, coming back to the earnings story, because it's been a roaring start on Wall Street as well. The biggest banks reporting record growth, but JP Morgan's CEO setting a cautious tone, warning of risks in the credit market with some choice language. Jamie Dimon's comments follow the collapse of the auto lender Tricolor, which resulted in a $170 million hit for the bank.
You should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, we think we're okay and other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
Oh, I'm sorry, everybody, if you're eating your breakfast that you had to hear the word cockroach. But Bloomberg's Charlie Wells is here to discuss. Charlie, put Jamie Dimon's comments into context for us. How do they reflect the broader sentiment on banking this earnings season?
So, Lizzie, that was the definition of what's known as owning the narrative, really kind of asking the question that has been on everyone's mind as we went into bank earnings season, which was what else is out there in the credit markets following that rapid set of bankruptcies in that auto lending space. He asked the question and did not shy away from the potential for trouble elsewhere. And this reflected other comments that we got from bank executives. You had Mark Mason at Citi talking about the consumer being a little bit more discerning in spending. And David Solomon talking about some winners and losers, some divergence in that AI space that we're seeing so much optimism in right now. This overshadowed some stellar performance. We can't overstate how stellar some of the performance was. Looking at investment banking fee growth up 42% in the quarter for Goldman Sachs. Stellar performance in that area across a number of other banks as well. Look at that huge jump, 42%. Then let's flip the screen and see how the market reacted. This might surprise you a little bit because we see a divergence in performance here. You remember that 42% in investment banking fees for Goldman. Well, you see their share price yesterday slipping a bit. You saw that for JP Morgan as well, despite these solid earnings, a jump at other banks. But this speaks to the fact that there was a lot of optimism going into this earnings season and some of this commentary overshadowing performance.
So there's the run-up to the earnings day, there's the earnings themselves, there's the commentary provided by the CEOs, and then the divergent performers. Charlie, what do we expect to see then from the major lenders who are reporting today?
We got two big ones on tap today. We have Bank of America. And when we think about that, remember net interest income. This was a factor that was overshadowed again a little bit yesterday, but we're operating in that new rate environment. So seeing how these banks, seeing how Brian Moynihan talks about the forward trajectory for net interest income, that will be striking today. We've also got Morgan Stanley. If you want to look at the share price of Morgan Stanley relative to some of the other competitors, you can see it is neck and neck when we look at that share price performance. Thinking about Goldman Sachs, its arch rival, we saw a little bit of too much optimism there on the equities trading front from Goldman. We could maybe see some downside surprises there. Bank of America, a little bit of a laggard. There's a world where there's an upside surprise, but we'll find out in a few hours.
Charlie, thank you. Bloomberg's Charlie Wells with a look back and a look forward on the banking story. Now, with global uncertainty in focus, how are those who manage money for wealthy families thinking about their investments? Deutsche Bank has been surveying family offices to find out. And joining us now is Adam Russ, Global Head of Wealth Management and Business at Deutsche Bank. So, Adam, nice to speak to you. Thanks for coming in. So clearly we had some concern from Jamie Dimon yesterday around private credit, and we'll get to that conversation, I'm sure. But just big picture, you've been surveying these family offices, asking them a lot of questions about where they're positioned and how. They're building credit lines earlier than they might in other cycles we've seen. What does that tell us about where their heads at, these family offices right now?
I think that tells us two things. Firstly, they are preparing to be able to invest actively and quickly if they need to. That's not a new phenomenon, and typically family offices have used investment leverage on financial securities for many generations. But secondarily, they're really getting into understanding the debt capacity of their illiquid assets. And they're doing that to prepare with more timeliness for bigger checks that they might need to write and rebalancing of their risk across their portfolios. And that preparedness is extremely important for illiquid asset financing because it just frankly takes longer to set up.
Yes. So yes, your mention of illiquid assets then takes me on to the private credit conversation. So these are family offices that have more illiquid portfolios than they used to, and that's partly because they're invested in more private market stuff of varying natures. Is that a concern to any of them? Are any of them worried about the fact that they've got less liquid portfolios these days?
Yeah, I think that's a good question. So in terms of when we talk about private markets, we think a lot about private equity, private credit and allocations through historical funded investments that have been made. But it's much broader than that. Right? In a family office's portfolio, you'll typically find lifestyle assets, so potentially yachts, aircraft, art portfolios, but also one asset class which has been quite negatively correlated to other asset classes has been sports teams. And frankly, as family offices have been allocated more and more, or those investments, frankly, have become bigger and bigger, that's, as a result, become a bigger part naturally of people's portfolios.
Right. This sounds like all the alternative investing segments we used to run on Fridays. Wine, yachts, football teams.
Yeah, the wine market's been an interesting one over the last couple of years as the Chinese are back down. What does dislocation mean to these people? What does it look like? Just kind of give me a sense of kind of... Does it mean different things to them than it means maybe to the rest of the financial market?
So I think dislocation certainly means opportunity in certain segments, but it ultimately comes down to how levered a client is going into this type of cycle. Right? If you look at the pressure...
So you say type of cycle. What are we when you say type of cycle, what do you mean?
What do I mean?
Understand
no, sure. Cycle. So look, I think family offices, and you'd have seen this in the results of our survey in the 209 family offices that we spoke to, over 60% of them hold significant real estate assets.
Right.
And if you look at, for example, US office peak to trough from early 2022 to about 6 months from before today is down 42% on average. So, you see a lot of family offices needing to reposition their portfolio, but opportunity then exists to potentially allocate more to some of those asset classes where they really understand them very well. So again, US office, we see a lot of clients now acquiring, especially in New York and Manhattan, where there's real opportunity to...
So which assets are at cycle lows right now that they're interested in?
Yeah, so, to my mind, I mean, it's real estate in the US. I think it's office in London. I mean, when I say real cycle lows, I'd say we're probably 3 to 6 months off the real cycle lows, which is traditionally a time that family offices will come in because they're never quite there when the private equity is there. There'll typically be a small lag. But now there's absolutely opportunity. I think then when it comes to public markets, we're seeing a return of the carry trade. So the carry trade has been quite quiet in terms of leveraging CLNs, leveraging fixed income instruments. A little bit more basis and, frankly, lower funding costs for banks means that trade is coming back.
Just going back to these war chests of extra liquidity that have been building up, how does that strategy change if and when the Fed cuts rates?
Yeah, so look, I think, how does that strategy change? If they cut rates, it's only going to encourage people to deploy it. And frankly, people's return hurdles are going to drop a little, frankly, because the cost of leverage is going to come down. So, what we've seen across a number of clients is them getting ready, setting up quite significant lines, but we are beginning to see people deploy. And maybe they're doing it in a way where, with equity markets, they're not necessarily going in straight cash equity, they're selling puts. Despite very limited vol over the last quarter, they're still selling some puts just to make sure they're coming in maybe 5, 10, 15% lower, if possible, versus where the market is.
So they're preparing for volatility. Are you anticipating volatility?
I think in this environment, I anticipate volatility. I mean, even I look at the an article that was published last night by yourselves, where you look at the retail sector within Europe. A number of our clients, of course, 65% of our respondents here were Eurozone based. A number of our clients will have operating businesses, a number of which are exposed to consumer goods, and of course with margin pressure, with tariff pressure, that only means that people are going to need to tap other lines of credit to support those business potentially, or go as far as raising other equity. So leverage across a client's full balance sheet helps them, basically maintain also their operating assets with not too much leverage, potentially operating level.
This is a group of investors that are really quite long term.
Very much so. Very much
like how the Pope thinks in centuries, isn't it?
So, I mean, does they're less bothered by the daily headlines around tariffs, threats, and all the rest? Is that the message you get when you speak to them as well?
I think, to your point...
I suppose they must take account of whether that changes the long-term direction.
Yeah, so investors ultimately, our family office is the decision maker, the UBO. There is no investor behind him, right? So he's the source of capital, the source of wealth, and he's the decision maker, which makes his decision-making process quite different often to that of a private equity fund. There's no need to return capital if he doesn't want to. So, I mean, if you look at a great example is UK real estate, right? So whilst we see a reduction in the amount of transactions that are happening in the resi space, and we're obviously very publicly seeing a number of ultra-high net worths leave the UK, they're not selling assets. So a political cycle might last 5 years, maybe even 10 years, but people aren't necessarily selling assets, and that's because their view on duration is much, much longer.
Yeah.
I'll leave it there. This is fascinating. Thanks very much indeed for sharing it with us. Adam Ross, Global Head of Wealth Management and Business Lending, joining us from Deutsche Bank. Coming up, France inches towards a budget.
Most of the solution belongs to the expenditure side. Part of it could be on the tax side, but again, it's a legitimate democratic discussion. We believe in democracy.
We'll be live in Paris next with the latest as Prime Minister Lecornu does a deal with the Socialist to keep his new government on track. This is Bloomberg. 45 minutes past the hour. We're tracking towards the open here in Europe, which I had to say is looking remarkably positive, particularly for French assets. Not only do we have French politics in play this morning, but we also have what looks like a very solid session in prospect for LVMH. But let's talk about the politics now, figure out what is happening there. The French Prime Minister, Sébastien Lecornu, has won, it seems, the crucial backing of the Socialist Party in the National Assembly for now. The Socialists, who, remember, hold leverage in the lower house, say they won't vote to topple Lecornu's fledgling government after the Prime Minister promised to suspend President Macron's unpopular pension reform.
C'est pourquoi je proposerai au Parlement dès cette...
This fall, I will propose to Parliament to suspend the 2023 pension reform until the presidential election. No increase in the retirement age will take place from now until January 2028, as specifically requested by the CFDT union. In addition, the duration of work taken into account will also be suspended and remain at 170 quarters until January 2028.
OK, let's go to Paris, figure out what is happening and what comes next. Caroline is there for us. OK, so we get a lifeline for Lecornu, and this improves his chances of surviving not one but two confidence votes this week.
Clearly, Sébastien Lecornu should survive the week with the votes of the Socialists, who have said they will not support this motion of no confidence because they claim that this suspension of the 2023 pension reform is a victory for the Socialists. This is something that they've been asking for over the past few weeks, and clearly they see this as a victory for their camp. Of course, that is assuming that all the Socialists respect the position of the party, but you could see Olivier Faure, the first secretary, François Hollande, the former Socialist president, clapping their hands while Lecornu was announcing the suspension of this reform. For the Renaissance Party, Macron's party, of course, it's a big gamble. They're not very happy about this suspension, but they knew also this was kind of the last chance for President Macron also to go until the end of his mandate in 2027. One Renaissance MP was saying this morning in French media, it's like a poker game. You need to pay before you play. So clearly the French government has to pay this price, sacrificing the flagship reform of Macron's second term.
So do you think that that suspension of the pension reform is going to be enough for the Socialists, Caroline, or is it like you give them an inch and they want to take a mile?
At least in the short term, it should be enough for Lecornu to survive and to start finally the debates on the budget. But Lecornu has also given Parliament the entire power. He said he will not use 49.3 article in the Constitution to force the budget bill through Parliament, meaning that the Parliament will clearly amend the budget. The initial draft was planning 30 billion euros of savings, including 1/3 of tax increases and 2/3 of spending cuts. Some tax increases, like the super tax on big companies that we saw last year, will be extended. Some tax on the wealthy as well. But the Socialists have said already they want more. They want the Zuckman tax. They want to tax those with more than 100 million euros of assets. We'll see if they get the majority in the National Assembly. Lecornu said Parliament will have the final say. We must not be afraid of that. Of course, what happens after the budget is passed is anyone's guess.
Caroline, thank you. Bloomberg's Caroline Conan joining us there from Paris. Let's widen the lens, talk about the markets in 3 minutes with our Markets Live executive editor, Mark Cudmore. Mark, the risk-on force seems to be strong globally for stocks. You've been pretty impressed, I think, by some of the dip-buying impulse. Where does that take us, do you think?
Yeah, I think the price action's been incredibly positive over the past week. That seems a strange thing to say when we've had the biggest short-term kind of dips lower that we've seen in 6 months. And what I mean by that is the bounce backs have been very, very quick. Now, the underlying fundamentals are very impressive. We know that the AI bubble, if you want to call it, and I believe it is a bubble, but we're at the early stages of it, is very strong. We're expecting a very strong earnings season. We're seeing that on both sides of the pond this morning, with ASML impressing as well as the US banks yesterday. So earnings expect to be good. We're seeing yields come lower. We're seeing growth still be resilient. We've got the positive news in France. So I think there's overall a very, very strong backdrop. And it's understandable to be expected 3 weeks' time we'll have a US-China detente, perhaps a progress in a trade deal, and stocks will be much higher. What I am very, very concerned about is the path there. Game theory suggests that there won't be an immediate backdown from either side, and particularly from China, has no reason to kind of offer concessions unilaterally until we get much closer to the deadline. So I worry we've got some very scary headlines in the next couple of weeks, and whenever you've got scary headlines, you've got a risk of things going wrong. So even though I understand the extreme bullishness, I am worried that the path is going to be more negative. We're going to have more sharp dips in the coming weeks, and I think people are maybe rushing to buy the dip a little bit too quickly.
OK. VIX is at 20. Does it stay elevated? Does it get more elevated? And if so, what does that do, particularly for the systematic trade? Kind of, what does that do in terms of kind of risk-on territory?
Yeah, that's a great question, because I actually think that's the key change. We've been in an extremely low vol rally over the last few months, exceptionally so, and we have seen a move up in the VIX. I think volatility will rise from here because of that expected headline risk out of the US-China situation, and also because we're in earnings season now as well. And as a result of those move higher in volatility measures, we are going to have systematic reduction of positioning. We're going to have a cut in leverage. And that's why we're going to get some more whip around. And these things become self-feeding. We know that volatility spikes are autocorrelated. Volatility begets volatility. And it's from that simple process that as you get a spike in, well, as you get a decline in volatility, people have to take more leverage to get the upside. And then when you suddenly get a spike in volatility, they then have to further reduce positions, which causes more volatility. So that is the exact dynamic I'm worried about. And I think it's really important to emphasize. It depends probably on your time frame how you play this. But I think it's only people who have very deep pockets, have very high risk tolerance, and can afford to be buying the dip quite so aggressively, because I think the path dependency is very, very important. And there's still a tail risk of it going materially wrong. If markets are completely complacent about US-China trade, there's no pressure on either side to make a compromise, and maybe we will not get a compromise.
All right, Mark Cudmore, we thank you so much. Bloomberg Markets Live Executive Editor Mark Cudmore there. And remember, you can get up-to-date analysis and insight from Mark and the team by going to MLIV Go on your terminal. Let's get your stocks to watch now with Chloe Melly. Chloe.
Good morning, Lizzie. Let's start with some highly anticipated earnings from ASML, and they are positive, so orders beat expectations in the third quarter, and that could help sustain the really impressive rally that we've seen in the shares over the last month or so. A lot of this rally had to do with this growing investor enthusiasm, this bullishness around AI, and this seems quite justified because the CEO said that he had seen continued positive momentum around that investment in AI. He did say, however, that sales in China will decline significantly in 2026. So we'll see how the market reacts to, at the same time, this beat, but then at the same time, we've also got this kind of lack of clarity around the outlook going forward. Moving on to another big earnings story, LVMH sales returned to growth in the third quarter, which was a positive surprise given expectations of a decline. Analysts are saying this is a step in the right direction. It shows that maybe that slowdown in luxury demand is maybe coming to an end. We could see that boosting the shares in LVMH. They have been underperforming their peers, Kering and Hermes, for a little bit. So we'll see how this picture changes at the open. And finally, let's stay in France and move over to a big deal in the telecoms market. So a group led by Bouygues has made a 17 billion euro offer to buy SFR from Altice France, which is owned by billionaire Patrick Drahi. So we should keep an eye on the two listed names that are involved in this deal. So we're talking about Bouygues, as I've mentioned, but also Orange. Both of those have been having a really good year so far. Let's see if they get an additional boost from this deal.
Thanks so much. Thanks, Chloe, our equities reporter, Chloe Melly. So today is brought to you by luxury handbags from France, or maybe champagne and rosé is where I should credit.
Rosé sales did very well, apparently.
Apparently so.
Champagne is back as well. I do. So what I'm also thinking is that actually the crypto bros have not had a good few days, and I wonder.
We see that next quarter.
Yeah, I wonder whether that's
Q4.
the kind of the fourth quarter story that we need to think about. That maybe the champagne sales won't be quite as punchy.
We will keep an eye on all of the luxury names in Paris and elsewhere this morning. We'll also be keeping an eye on car maker Stellantis could be on the rise, so keep an eye on that one with its commitments in the United States. This is Bloomberg.
Wednesday morning, good morning. So what was yesterday about? Yesterday was about cockroaches, cooking oil and the Federal Reserve. It's not a combination you normally see, but it was an interesting one for the markets to digest. Jamie Dimon warning about cockroaches, Trump threatening cooking oil, but Jerome Powell won. He was the one that really set the tone yesterday, signalling 2 cuts are still coming. Basically, we're good to go. That was the narrative that got nailed on yesterday, and the market liked it towards the back end of the session, and that's why we had a decent rally in the US market, which it looks like it's going to continue this morning here in Europe.
Exactly. It's green across the screen for the European futures picture this morning, Guy. I would pay you to stop using the word cockroaches, but moving on to other things. Look, it is the CAC that's driving the futures picture this morning, and that's for 2 reasons. One, we have Prime Minister Lecornu finally seeming to have reached a compromise with the Socialists that could mean that he avoids a no-vote confidence vote in Parliament, but also, Anna, it comes down to the single stock story of those LVMH sales.
Yeah, absolutely. Let's talk about that then. Champagne, rosé, we've been talking about those. Those apparently have been selling well. China is back. That is a theme that could put a fire under luxury names more broadly than just LVMH, but certainly that is our initial focus. The ADRs were up by more than 8% in the United States. We watched the luxury sector this morning. ASML certainly in focus as well. We're back into earnings season. Q3 bookings came in better than expected over at the chip equipment manufacturer. They were speaking quite positively about Q4 and 2026 guidance, planning a buyback. There'll be more details on that. A little negativity on China, but that may not stick in the very short term to the share price reaction. Let's focus in on Stellantis, the car makers as well. This one could be on the move higher as well after they've announced a big investment, well, $13 billion in the US over the next 4 years, Guy.
OK, here we go. Let's talk about this market open. You have to bear in mind and think about what happened Friday when you think about what has happened at the beginning of this week. And we've been struggling to fill the gap in terms of the sell-off that we saw Friday. Maybe we'll get there today. The FTSE's out of the gate, up by a little bit. I'm not watching the FTSE today. I'm interested in what's happening in France. That's going to be the trade today. What happens with the likes of LVMH? Did you see the ADRs last night? They were up 8-9%. Really decent pop coming through there. Expected to be replicated here in Europe this morning. ASML's a heavyweight in terms of the cap weighting. Therefore, it's going to have a big impact on the upside this morning. The IBEX is up by 0.3%. I've been rather remiss of leaving maybe the AEX off this market this morning. But we wait for the CAC to see how long it's going to take that to stock that market to get open and what the single single stocks are within it going to be moving. Maybe we'll see the banks moving. Maybe on the politics story, we're certainly going to be watching very carefully what happens in tech this morning. But it's LVMH, MC, looks like it's going to be the main driver of this market this morning. It's not going to open. It's not clearly in a hurry to get things going in France this morning. So let me hand things over to Lizzie to see if she can give us a little look under the hood.
Yeah, I believe LVMH has halted for now, so we're waiting for the luxury names to open. But when you look at the sectoral picture, in the absence of luxury, it's autos that are leading the gains, so up 1.5%, and serious gains for Stellantis, up more than 4%. We'd already seen the stock up in the States and really yielding to the tariff pain with this $13 billion investment into the US, as you say, Anna, and that seeming to boost the stock this morning. Another few of the other names that we're watching, ASML, of course, off the back of their earnings, but also factoring in the geopolitics. The stock up 3.2%, so significantly higher, actually, than we had anticipated from the TradeGate suggestion. And Bouygues as well, up 3.2% off the back of that M&A.
Yeah, technology jumping to the top of the gainers board, and so we are seeing some positivity there. It's interesting that we don't have an opening yet, not just for LVMH, but also for Kering, for Richemont, for Christian Dior, for Burberry. All of these stocks taking a little time to open this morning as we rethink the Chinese consumer around luxury, which is kind of amazing, given that what we got was an increase, what was it, 1%? An increase in group sales over at LVMH, so maybe we curb our enthusiasm slightly. But it was unexpected that we got that increase after 2 quarters of retreat.
Absolutely. There are notes floating around saying, actually, yes, the comparables were easy, but actually this was better than the comparables were. That doesn't tell the whole story. This was actually better than that kind of picture that the comparables paint. But we don't still have an opening for them. There's 3 stocks unchanged on the CAC 40 right now, and they're ones we're going to watch out for. Actually, I think I've just seen a number on Kering, so it looks like that one is maybe starting. I've still got Kering flat, so nothing moving there. So I've got Hermes, no change, LVMH, no change, Kering, no change.
Well,
they're thinking about it.
Yeah, well, while we wait for them, let's get some analysis. Christian Müller-Glissman, Head of Asset Allocation Research at Goldman Sachs Research, joins us round the desk. Good morning to you.
Morning.
How are you feeling? Do you just put the tariff noise on mute, see it all as a diplomatic dance, embrace the Fed cuts and power ahead?
Well, I think, it's getting more bumpy, and I think it's been a very uncomfortable Goldilocks backdrop since the summer. Like, the markets have taken relief from the Fed easing, but they're easing because of a weak labour market. At the same time, the corporate sector has been very good, but now we haven't had a lot of data. No, the labour market hasn't been there. So the earnings season, I think, will be critical, because it's the first time we're getting more data, understanding how strong the corporate sector really is. So I think that will dominate. There's a lot of uncertainty on politics and geopolitics, as always, and you kind of want to be careful about making too many shifts on your portfolio based on that. So we're still modestly pro-risk, if you're asking how we're feeling, and we're going into this earnings season with a view that it kind of probably will validate that the corporate sector is still in relatively good shape. And we actually think in the US in particular, the expectations, which is roughly 6% for that season, they probably will be beat again.
So if it's all a bit bumpy, how big does a dip have to be to buy it?
Listen, it's always dependent on what the dip actually is, like what the drivers are. If you have a major trade escalation, of course, we need to be careful. We need to understand kind of what the ramifications are for the economy. I think rare earth is something that has a real disruptive potential. And as a result of that, if there is some type of complete gridlock on the negotiations, I think we would have to be a bit careful. But I would say that the current backdrop, where you're somewhat late cycle, unemployment rates are very low, profit margins are very high, is quite conducive to buying the dip unless you really see a sign of a recession emerging. So what I'm watching is, if we get a dip, is the yield curve flattening, and are cyclicals versus defensives really sharply leading the market lower? So I think if these two signals are happening, that tells us that the market is losing faith into the stability narrative. And I think we haven't seen that yet.
Let me just update on what's going on with the luxury sector, because we don't have LVMH open, but we have some of the others in the luxury space open. Christian Dior up by 10%, Kering up by 6.8%, Hermes up by 5%. Let's get an update from you, Christian, on the luxury space. And one of the positives that the market perhaps is clinging to this morning from the LVMH numbers is that China was an area of positivity, doing better than expected. Does that tell us something important?
Well, the way I would think about it is like tariffs really since Liberation Day have weighed on a lot of places more than on other things. So I think like luxury goods is to some extent one of those places where the market was very worried about second round and first round effects of tariffs. And now you have potentially turned the corner. I think you have a strong result. It seems expectations have come down enough. That sector has really been performing terribly for some time now. So I think maybe that's kind of why you get the relief now. I think generally we have to admit the consumer globally is holding up relatively well, especially the high-end consumer. Like what I always give as a statistic, 50% of consumption in the US is done by the top 10 income households, top 10% income households, which tells you they're probably the buyers of luxury goods as well. So that cohort of investors have huge tailwinds from wealth, huge tailwinds from income still.
Yeah.
So as a result of that, maybe we've started to turn the corner a bit.
Yeah, so maybe there's this correlation between the AI trade and luxury sales when we're looking at things from the US perspective. So the CAC is now open strongly, as you'd expect. Still no opening price on LVMH. We talk about tariffs there, and we were talking with our colleague Mark Cudmore in the last part of the programme about whether we'll see more volatility heading towards this still, I think, anticipated meeting between Trump and Xi, although that's not entirely certain. Are you bracing for more volatility? Because even though we've had a lot of drama in the last months, we haven't had a huge amount of volatility. Things have gone up quite steadily.
Yeah, I think like this is the type of Goldilocks backdrop I described earlier. If you have like growth going up without inflation, that's the traditional Goldilocks. What we had since the summer is essentially the corporate sector holding up really well. And the Fed is shifting more towards easing, and it has a similar volatility dampening impact. But there's one other thing that's really important is we're just entering earnings seasons. And if you look at the implied correlation within the S&P 500 options market, it's at one of the lowest levels in history. So the market expects this a very dispersed earnings season, very micro-driven. So that means that you have two things fighting here. There's more macro risks emerging with tariffs, but you also have a lot of micro news flow. And that means that theoretically that should anchor volatility at least. That's how the market is priced. But if you expect the macro to start to take over, you could argue that index volatility is a bit cheap because the implied correlation is so low.
Let's talk about pest control.
Oh, well done.
Didn't say it.
He's avoiding the word.
Cockroaches in the credit markets. Jamie Dimon's worried about them. How late cycle is credit now, and what is the signal for equity?
Yeah, we're underweight credit, we're overweight equities. So we kind of feel the asymmetry in equities is much better because you have convexity that comes from innovation. Valuations haven't gone up that much since the summer. Like most of the returns in US equities have been driven by earnings. In credit, spreads have tightened further. So you were asking, are we late cycle? I think so. I think there's a lot of things that tell us that we're late cycle. Unemployment rates are low, profit margins are high, risk premia are compressed. Normally what happens late cycle is you get releveraging. This was a very accelerated business cycle. Coming out of COVID, you remember the economy recovered very fast. And because it recovered so fast, you generated inflation and you generated a lot of Fed tightening, which prevented releveraging because you pushed up rates so fast, despite the fact that you had the unemployment rate so low and you shifted late cycle very quickly, you didn't get the releveraging. There was never confidence. There was always fear about the recession. There was always fear about the cost of capital being too high. And now I think we found that equilibrium and we really see these releveraging tendencies. Biggest LBO in history. No, we have like obviously certain cracks emerging in the private credit space. We have the Oracle deal, which was financed in a heartbeat. So to me, I think we are now in a bit of a releveraging phase, and that means credit quality will deteriorate. And at the margin, you will probably see a few more unpleasant headlines coming out of the credit space. And since the beginning of the year, it's been the biggest inflow story. So it's been a lot of flows into credit.
How long does the last phase last for?
That's a great question. It can last a very long time. It can last a very long time because if you look at private sector balance sheets in aggregate, they're very healthy. So like if you normally look at like late cycle backdrops, you get breadth in the releveraging. Think about the global financial crisis. You're not seeing that. Like currently you have selective areas that are levering up and selective areas that are being called out partially because of tariffs, because these are business models that levered up too much and they might have had a hit from the tariffs. But I think you don't see the breadth of the releveraging. we could easily have 2 to 3 years of releveraging with more M&A, more corporate activity.
And equities just go up in that phase?
Sorry?
And equities just go up in that phase?
They usually do. I think late cycle investing is unpleasant. It's normally not Sharpe ratio. Very high. Like, this is a very interesting thing. In the late 90s, equities squeezed up with very high volatility. That we haven't seen yet. I think the markets are still trading a very friendly Goldilocks-ish late cycle backdrop. But once things actually get a bit more heated in terms of releveraging, reflation, actually then it normally gets a bit more volatile, but equities can still make progress.
So we might be worried about private credit, and that's a very useful conversation in that context, Christian. Some might be worried about bubbles in AI trades as well. Is all the risk attached to that clear to see? Is it all out there in the open? If something bursts, how systemic could something like a bursting of an AI bubble be?
I mean, listen, we've written quite a bit on that recently, and there's a few things that are important to note. I mean, we just published this morning a big report which tracks everything that exists in the world. We call it the world portfolio, 270 trillion.
Wow.
And one of the most interesting stats came out of that. Currently, global equities are 50% of that portfolio. If you look in the late 90s, they were 65. If you look in the 60s, Nifty 50 bubble, you were at 60. So, like, from the size of equities as an asset class, it doesn't look that bubbly. And also, I would say the AI ecosystem, where a lot of people are finger pointing, is very different to what happened in the tech bubble. In the tech bubble, you had a lot of companies that were call options on a tech revolution. And let's assume the internet wouldn't have come about and it would have been a fake news. All of these companies, including Amazon, they would have been worth zero because there is no internet. So think about now what happens if AI would not turn out to be as successful. All these companies that are currently in the news and that are very large, they would still have a business. They would still have a business model. They're diversified innovation conglomerates that actually have strong balance sheets. And that means to us, it looks much less bubbly compared to, for example, the tech bubble. But we need to be vigilant. And I think one thing you mentioned is credit. I think this ecosystem is now accelerating. And there will be on the side financing, there will be on the side capex beneficiaries that are more capital heavy, that require more leverage. And we have to watch those to see if there's excess. But at the margin, we've been saying that we're pretty early if there is a bubble, and there's not as many signs compared to history that would make us concerned.
Great to see you. Always a pleasure. Thanks very much indeed for dropping by to see us. Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs. So we're still wandering around the shop trying to figure out what the price of an LVMH handbag actually is. It's still not open in Paris, and we're waiting for a price. Clearly, we are going to see a big gap this morning in that stock. We're already seeing some of the luxury names moving sharply to the upside. Let's talk more about what is happening with the market this morning and the absence of that LVMH trade that you can see on the screen. Chloe Melly, over to you.
Good morning, guys. So, yeah, LVMH, it's just open right now, up 12.3%. Great time. So LVMH posted a surprise return to sales growth in the third quarter, which indicates that maybe this slowdown in luxury demand is easing, is maybe coming to an end. And that is driving the shares massively up this morning. We're up almost 12% for LVMH, and it's also driving up the rest of that luxury sector in Europe. We've got positive movements in Hermes, Kering, and Christian Dior as well this morning. Moving over to Stellantis, which is also up this morning after announcing a $13 billion investment in the US over the next 4 years to try and reduce the impact of those tariffs and refocus on that key US market. So this is an investment that was expected. We were expecting about $10 billion, but the confirmation of that is driving the shares up this morning. We are up 3% on the back of this. Moving over to ASML, and we also are in the green for ASML today, up 3% after orders for its chip-making machines beat expectations in the third quarter. That was driven by a really high demand for this AI infrastructure, and so ASML is continuing the rally that we've seen in the shares over the last month or so. Moving on to France, where Bouygues and Orange are also up this morning. There's news that a group led by Bouygues, Orange and Iliad, which is another private telecom company, is buying SFR for 17 billion euros from Altice France, which is owned by billionaire Patrick Drahi. This deal will mean that France will go from a telecom market with 4 operators to just 3 operators. And the news of this deal is driving the shares up this morning. Bouygues in particular, given that it is leading the group, so we are up 8% on the back of that. And finally, let's end on one negative movement this morning. We are down at almost 3% for Nexi, which is a payments provider. It was downgraded to a neutral rating by BNP Paribas, and therefore it is down this morning 3% for Nexi.
OK, thanks very much, Chloe. Chloe Melly from our equities team. The French market really on fire today, up by 2.3%, the most since May. We'll have more on the markets next. This is Bloomberg.
Welcome back to the opening trade. We're about 90 minutes into today's session, and as you can see, it is green across the screen for European stocks, but particular outperformance for the CAC 40 in Paris. Thank you to LVMH returning to growth, but also with Prime Minister Lecornu reaching a deal with the Socialist. We'll get back to LVMH in just a moment, but plenty of other corporate stories out this morning. Just look at ASML. Those shares up more than 3% after their third quarter orders beat expectations as that AI arms race boosts demand. We could get more now with Dasha Afanasieva, who is Bloomberg's Amsterdam bureau chief, but joins us today in London. Good to see you. Do you think the results are that good? Like, would the share price be higher were it not for the tariff story?
The share price could very much be higher were it not for the tariff story, because there is a bit of an overhang because of the geopolitical tensions. But I think besides the orders beat, you've also got a more positive outlook on next year than they had last quarter. So they'd said that they couldn't confirm growth for next quarter. Now they've sort of tweaked it to saying that sales are not going to be any lower. So we're looking at flat or higher sales, which a lot of analysts have said is good enough. They also pointed to a fourth quarter that is between 9.2 billion euros and 9.8, and analysts expected 9.2. But against all that positivity, there is the China story, and we are seeing an escalating trade tensions between China and the US. This week, we've spoken about how the Dutch government seized a chip maker in the Netherlands, all because of these heightened tensions, and we don't know how that's going to play out for ASML, which already faces export controls in China.
Yes, and some pretty negative language about China, but that doesn't seem to be sticking overtly, at least, to the share price this morning. Dasha, thank you very much for joining us. Dasha Afanasieva, Bloomberg's Amsterdam bureau chief. Let's pivot then from that large European corporate to LVMH, which certainly is also flying, even more so, up by more than 12%. LVMH has unexpectedly returned to growth in the third quarter. For more, we're joined now by Bloomberg's Angelina Rathgray in Paris. Angelina, what fueled the growth then at LVMH? We've been talking a lot about the product lines that are drinkable at LVMH.
Hi there, Anna. Yes, indeed. I mean, importantly, all the divisions beat, including the key fashion and leather goods one. Even though it still posted negative results, it was better than expected. And the CFO of LVMH explained that this was due to improve traffic and volume, so not a price effect. Importantly, the struggling wines and spirits division, which was in a downturn for the past 2.5 years, returned to growth, and that was helped by champagne restocking in the U.S., by solid rosé wine demand, even though cognac demand is still struggling. Selective retail also beat, helped by a strong performance of Sephora in the U.S. And geographically, Europe is the only region that worsened. That's due to lower spending by American tourists because of the weaker dollar. But otherwise, crucially, the region that includes China is back to growth. So in mainland, demand is positive again. Offshore, so if you think about Hong Kong or Macau, it's still down, but it's improving. So overall, that was pretty positive. The CFO also talked about the impact of the creative changes that we've seen in the past year. New designers are being appointed, and she said that the impact of those changes will be seen gradually in the first half of next year.
I feel like I'm out of my depth talking about the new designers. Lizzie's all over that one. Angelina, thank you very much indeed. Angelina Rathgray joining us out of Paris on LVMH. More comfortable on the car story, so let's go there next. Stellantis says it will invest $30 billion in the United States over the next 4 years. This as the, let's call it a global car maker, seeks to curb the impact of tariffs and turn its business around stateside. Joining us now, our global auto editor, Craig Trudell. This feels like a kind of role reversal. Europe's had the limelight from Stellantis over the last few years. Is it just as simple as it's now the US's turn, and that's probably because of tariffs and various other factors?
Yeah, I mean, you had two European, dynasties, the French and Italians, and the Alcons and the Peugeots, combining to form this company, and it was run by a Portuguese guy, largely from France, for years. There was a lot of neglect in the North American business under Carlos Tavares, and a lot of sort of festering issues that really came to a head late last year. So you've seen this company try to come back from that, and it's been really a slog. I think the amount of investment here is significant. The sort of specifics of it in terms of more Jeep production, more production in the U.S. You're seeing Illinois, Ohio, Michigan, and Detroit in particular, getting a lot of attention here. And interestingly, the sort of losing out that we can tell so far is Ontario, that Canada is going to feel some effects of this. There was plans to build a Jeep at one of their two big plants in Canada. That is now into question. So will Mexico lose out? Doesn't seem like it. It seems that the Canadian business is now the one that is sort of on the outside looking in.
If you're going to build in the US, are you building petrol engines or are you building EVs? Because if I listen to GM, I'm thinking it's the petrol engine.
Yeah, it's very little electric in this announcement. There is one extended range electric vehicle alluded to in Warren, Michigan, that will be built, but there will be an E-Rev version alongside a internal combustion engine.
The GM story is enormous. It has industry ramifications in what they're signaling.
I think it will be the first of several announcements that we hear from GM about them taking charges, unwinding some of their EV investment. And then I think we're going to see more of it for some of these other OEMs where, Stellantis really kind of took it on the chin yesterday. And the best I could sort of surmise from that move was that some of the investment that was made under Tavares to try and play catch up with electric vehicles, which Stellantis desperately needed, doesn't need it anymore.
So that's one of the things we'll watch with the European corporates when they report then, Craig, about the push into EVs and where is that still intact and where is it faltering. I noticed that Jefferies has downgraded BMW today. What else are we watching as we head then into the crucial European autos reporting season?
Yeah, I think one interesting trend we've seen is some of the companies that have been the strongest executors. I would put BMW in that camp. Also Ferrari, that was sort of the high flyer that was staying above it all last week, really had a tough day when it was supposed to be a celebration of their new electric vehicle and sort of a look forward to the sort of midterm plans. I think some of the companies that have done best, even they are now succumbing to some of the pressures that we're seeing. And my read of that downgrade at BMW it was more a sort of a relative play of some companies that have had a hard time, maybe seeing some value in those names.
Craig, thank you very much. Thanks for the update on the auto sector. Our autos editor, Craig Trudell. Stick with Bloomberg. We will be speaking exclusively with the Ferrari CEO. That conversation on the close, 9:15 p.m. UK time. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and as you can see, the picture looks like this. We're broadly higher across the European continent 30 minutes into the open. Particular outperformance, though, out of Paris. We're up 2.5% almost. Thank you to Prime Minister Lecornu getting that deal with the Socialists in the National Assembly, but particularly thank you to LVMH with that return to growth, that unexpected return to growth, powering the CAC Cajon higher this morning. Guy, you've got more of the winners and losers.
Oh, yeah, we are definitely on the front foot this morning. As you can see, 464 up, 125 down. Volume is good. I'm thinking a lot of that volume is going through France this morning and the French market. Let's talk about the winners and losers. 52-week highs, 52-week lows. Get this. Kering is trading at a 52-week high today. This stock has made something of a comeback over the last few months. Part of that down to the kind of the creativity coming out of the company, the reorganisation, the new CEO, all coming in and playing their part, and the market is rewarding it, probably on the heels of LVMH today. But Kering at a 52-week high, we're up by nearly 40% on a one-year basis. Sort of in the same space, but at the other end of the spectrum, maybe you could argue, is Pandora. Certainly when it comes to the market picture, it is at the other end of the spectrum. This stock is down by 23, nearly 24%, and is trading this morning at a 52-week low, Anna.
Yes, so European stocks getting a boost from the earnings stories and from what we've heard from the Federal Reserve. So let's go to some of our other stories to highlight just that. Fed Chair Jerome Powell has signalled the US central bank may stop shrinking its balance sheet in the coming months. Speaking at an event in Philadelphia last night, Powell also indicated American labour market prospects are continuing to worsen. US Treasury yields fell to the lowest levels in weeks on his comments, with bets on 2 Fed rate cuts by the end of the year remaining intact. Apple's Tim Cook is promising to boost investment in China. This despite the tech giant facing significant pressure from the Trump administration to shift production back home. Apple still makes the bulk of its handsets in China, and the country remains a key market for the business. That said, Bloomberg is reporting that the firm is planning to make its new smart home devices in Vietnam. Sticking with trade, President Trump is ramping up pressure on China, threatening new levies targeting cooking oil and calling Beijing's refusal to buy US soybeans, quote, an economically hostile act. Research by Bloomberg shows exports of used cooking oil to the United States were in retreat before the latest flashpoint in the trade war. So plenty of thinking about the twists and turns of the trade narrative and the whiplash that is created in markets by these trade headlines, Guy.
Let's get into the kind of the pointy end of that story and figure out exactly how you manage a trade war if you are in the logistics business. In order to do this, we turn to Jennifer Sabasaja, who's in Johannesburg with the perfect guest. Jen.
Yeah, Guy, somebody who knows probably all too well some of the whiplashes of the trade tensions, as Anna was just mentioning there, is John Pearson, who's joining me in studio. He is the DHL Express Global CEO, joining us here in Johannesburg. John, great to have you on set.
Good morning,
Thanks so much
Jennifer.
for being here. So, you know, over the past few days, as Anna was just mentioning there, we have seen ratcheted up tensions between the U.S. and China. From where you sit, what has this back and forth and some of this tension of 2025 done for the business?
Yeah, well, US-China trade is lower than it's ever been. It's at a level of now, I think 9% of US imports come from China, and there's some element of decoupling there. But that's sort of not old news and to be a little bit expected. I think what we've got to focus on is how trade is performing outside of those lanes. China growth to Sub-Saharan Africa is at 26%. China growth to Asia is at pretty much an all-time high. So I often use this analogy that, you know, water will find a way. And whilst arguably one country is retreating from trade, 219 other countries are embracing it and trying to find deals and sending things to countries and companies that they haven't sent before. But it's undeniable, and I think it's expected as a result of the tariff situation and de minimis that the China-US trade is, you know, dropped this year.
What's the best case scenario here, especially if you think about logistics and shipping, which is the backbone, which is your company, right? What is the best case scenario come November 1st if we do, in fact, see talks happening?
Well, the best case scenario is that everything settles. There's 1 or 2 big trade deals left to do, notably India and notably China on November the 1st. And if there's good news comes out of that meeting on November the 1st, that it settles back at a more acceptable level than these stratospheric levels they are now, I think we go into New Year with every country knowing what their tariff rate is and formulating, you know, we should never underestimate the creativity of buyers and sellers who want to do business, make deals, sell things, export things. They will find other markets. So I think the best situation is that the 2 big deals get done at a level that both find some sort of acceptability in, and we go into New Year not talking about tariffs or de minimis very much.
Are you preparing, though, for a situation in which that might not happen? What does that mean for your business?
We're a global company in 219 countries. We're prepared literally for everything. You know, we've been through COVID, which was the biggest thing for 102 years, and now we get into this tariff situation. Our job has been to spend time with our customers and answer their questions.
Let's talk about some of the new investments, though, the company is making, which is part of why you're here. 300 million euro that you're investing into sub-Saharan Africa. Is this a result of some of the friction that we're seeing elsewhere? Why is this happening, and what is this money going towards?
Yeah, I think it may be the result of the friction. What it's the result of is that when we open a new facility, a warehouse, a distribution center, a head office, is because we're growing. And if we're growing, it says quality is high, but the Africa Free Trade Agreement is probably working because intra-regional trade is Africa is at an all-time high.
And it's not even fully implemented.
And it's not even fully implemented. And I urge policymakers to finish those last bits off. But as I said earlier, the import growth from China to sub-Saharan Africa is 26%. That's machinery, that's construction equipment, that's things that are going to be used to make things, which tells me that the African economy is relatively strong and strengthening. In fact, the scorecard for sub-Saharan Africa is very good. Of the growth, of the trade growth in the first 6 months of this year, sub-Saharan Africa topped it. And the other fascinating thing, which I don't think many people recognize, was that the trade growth in the first 6 months of this year was the fastest globally in the last 15 years, apart from one pre-pandemic spike. And that was because China was pumping goods into all areas of the world other than the US, and there was a lot of forward ordering ahead of the tariffs coming in. And you amalgamate those two facts, and that is what drove that statistic I just mentioned to you, which was a surprise to many and a positive surprise to many.
Surprise to you as well?
Surprise to me as well, yeah.
Let's the 300 million euro. What is that going towards? More warehouses, fleets? What is this?
Exactly. In our business, it's more planes, it's more warehouses, more distribution centres. It's a fantastic head office in Midrand here in South Africa, and I think you group those investments under people, quality, and growth. You know, what we give to our people is the best possible facilities. What we drive for our growth is the best possible life science healthcare facilities, cold chain facilities, you know, e-commerce setups. So the industries that are thriving on the continent in Africa: life science healthcare, energy, renewables, e-commerce, and agriculture.
Does that number, 300 million, potentially increase over time if, in fact, this is the growth engine in many ways?
You know, we put our money where the growth is. So the reason we're putting 300 million in now is because there is so much growth that we know is coming our way. We're looking round the corner, if you will, as to how these things may end up.
What are the tailwinds that potentially fuel some of that growth?
Well, the tailwinds are that there are a number of countries of which South Africa is one. Those countries that are anticipated to grow faster than any other countries on the planet. And that may be because of FDI inward investment. It may be because of a strong domestic economy. It may be because the China Plus One is putting Chinese organizations into South Africa.
Right.
In fact, we've now got 40 Chinese salespeople dotted around the world, ready, and I like to say it this way, ready to greet Chinese executives off the plane and say, how can we help you with your new plans in South Africa, or your new plans in Egypt or Thailand or Colombia or wherever it may be.
How would you assess the state of global trade then? Because it seems like maybe there's one country that is being left off while the rest emerge.
Global trade is resilient and robust and reliable.
No concern.
Well, every time we produce the Global Trade Atlas or the Global Connectedness Report or the Global Connectedness Tracker, it confirms that trade, global trade and globalization is on a very strong trajectory, and that's taken from 20 million data points. You know, sometimes it's said to me that you're too optimistic. I just take the data points and I see what it's saying. You know, one example of that is trade still travels over 5,000 kilometers on average. That's more than it did 10 years ago. So if trade globalization was giving way to regionalization, the number would mathematically come down. And it's not. It's still over 5,000 kilometers.
So optimism here.
Yeah.
All right, we have to leave it there with you. John Pearson, it's been a pleasure having you in studio.
Thank you, Jennifer,
John Pearson,
and thank you to your viewers.
the DHL Express Global CEO, joining us here in the studio. Guys?
All right, Jennifer Zabasaja, thank you so much for that interview. Both Jen and the DHL CEO were both in Johannesburg. And as we talk about those US-China trade tensions, at which is at the absolute coalface of, we're looking at gold hitting a fresh record, not just because of that, but also because of these Fed rate cut signals as well. It's cleared $4,200 a troy ounce, now at 1.5%. We're going to talk about commodities next. We're going to be speaking to Trafigura's chief economist, Saad Rahim, joining us to discuss that, the debasement trade and broad investing in commodities. That's next. This is Bloomberg.
"44 minutes past the hour, Wednesday morning." That's what's happening with equities. And equities are exciting this morning. France is fascinating. What is going on with LVMH is worth watching. Take a look at what is happening with gold and silver this morning, and life gets even more interesting. You've got gold clearing 4,200 this morning. We're at 4,205 this morning. We're up by another 60. Silver is ratcheting higher again. We're up by another 2.4% there. These are big gains. The debasement trade is absolutely on again this morning. You've got a dollar story which folds in what's happening with the Fed as well. All of this, I suspect, is top of mind when we think about what is going on in terms of the conversations around London Metals Week, LME Week, which is on at the moment, which means we get some great guests passing through here at Bloomberg. Saad Rahim is the chief economist at Trafigura, is one of those fantastic guests that joins us around the table. Good morning.
Good morning.
Great to see you.
Thank you.
What does the debasement trade mean to you? And is this the way to play it?
Well, I think the word debasement is a big word, right?
Oh, yeah.
It covers a lot of ground, so I think it's very clear. We need to be clear, I think, on what it really means, because, as you say, at the start of the year, this was really about a dollar debasement trade, right? And people saying, okay, you know, if you even think back to the Mar-a-Lago Accord and what was happening around that, seems like a long time ago. And, you know, and where people were expecting the dollar to go and then looking for store value somewhere else. Now, it's come to mean much more around concerns around long-term government debt, in particular in developed economies globally, right? So it's not just a U.S. thing. It is also Europe, the U.K., it is Japan. And so people have been saying that's the new debasement trade, and we're worried about that longer term. But what's been interesting is actually, despite a lot of those headlines and the chat around the debasement, you know, it is really gold and silver. Silver is the best performing major asset class out there, up 80% this year. And gold not far behind, you know, absolutely outpacing the S&P, outpacing MSCI World. But if it's really that as well, people are also looking at crypto, and crypto hasn't moved as much, right? It's up at only about 20%, so not quite the same trade. But you look at then U.S. yields in particular now are down, right? So if it's really a debasement trade and people are worried about government debt, then why is the 10-year trading just at 4%?
Okay. So why is gold where it is, and is it going to keep going at the kind of pace that it is right now?
I mean, I think it's been a trade where, you know, in particular, a lot of it is being driven by physical buying, and in particular, if you look at central banks who are going out and buying, you know, huge quantities of this. So I think last year it was China's central bank, so China, India, Russia, Brazil.
And they're price insensitive, you think?
And they seem to be buying. I mean, they paused a little bit when prices rose last year, but obviously even at these levels, they're continuing to buy. But these central banks bought 30% of the mined gold output, or at least equivalent, last year. So they're obviously looking at this as a longer-term trade that they're going to, you know, trying to enter into. Now, what we are seeing in other commodities as well is there appears to be some strategic buying of physical commodities, right? So if we look at oil, for example, one of the key stories in oil markets this year has really been China's buying of crude oil to put into strategic storage. Are they perhaps worried about a dollar debasement, you know, as has been talked about by the administration, where they're looking at it saying, look, you know, we hold a lot of dollars. If these dollars may be worth a lot less, and at the same time, commodities priced in dollars then may be higher, well, why don't we convert these dollars into something that we know we're going to need later? So you look at crude oil, you look at iron ore, perhaps to a degree what's happening now, they're building copper stocks, you know, counter-seasonally in China. So maybe a lot of these things are related as well.
This always has the potential to turn into a conversation about FX then, Saad, given all that you've outlined there, which I don't want to do. I want to keep our focus on metals, but it is worth exploring the role that China is playing right now. And it's interesting. Is China then nervous about seizure of dollars if there were to be any kind of conflict, loosely defined? Is that what is... Can you see a line between what the PBOC is doing and the gold price? Is it that obvious?
I think it's part of it. I don't think they're the only ones who are buying gold. I think a lot of investors are moving into gold. Again, you're looking at it saying if there are concerns about rate cuts coming, but again, potentially pushing the back end of the curve then up due to those longer-term debt concerns, then people are looking to gold as a store of value and as safety. And also, I think that's maybe a little bit the drive to safe havens, which is driving the yields to come down again in the U.S. a little bit. But I do think that central banks, and they have been, I think, quite open about it, this concern that after the invasion of Ukraine, Russia's dollar assets were seized and held, and so this is a concern, I think, for some of these banks that potentially in any kind of conflict, doesn't have to be kinetic, it may be something else, maybe even in a trade war type scenario, where if we've seen this week this kind of escalation around rare earths and trade, maybe that's a scenario they're worried about.
Yes, and I wonder if other central banks are also worried about it, because we were listening to the French central bank governor saying that we mustn't break international law on Russian assets. It seems as if that's sort of in their mind, and I wonder if that's linked to the discussion we're having. So China in focus because of the gold they're buying, but also in focus because they're trying to push some of the trade in the commodities that you follow into yuan. How successful are they being at doing that?
I think it's increasingly becoming a feature of these markets. It's always been there for, or at least for the last couple of decades, where they have done some trades, they've tried to denominate it in RMB, but what we've seen reportedly now is they're asking for BHP to start trading some of the iron ore, pricing that in RMB. And we're starting to see it again in other trades that they are starting to do. So clearly there is a shift towards that, which I think makes sense. They are the second largest economy in the world. Obviously, it's not a free-floating currency, so there is a question around that. But it does seem from their side that they do want to push some of that trade there. But what's interesting is even farther afield is if you look at Russia and India, some of the trades that they are doing on the oil side are also being denominated now in RMB. So it is not just China, but other banks, other countries that are also starting to do some of this as well.
We're just showing copper there on the screen next to you, Saad. It's within a whisker of a record now. Kenny Ives at Metals Week talking about it touching 12k a tonne. Does it worry you, though, that it's been more supported by supply factors than demand factors?
I think that's always a concern. As our head of metals research, Graham Train, always says, that's sort of the least bullish way to be bullish is if it's on supply, because those are issues that can be addressed in time, right? So really, if you're going to be bullish longer term, demand really has to be a big part of it. So there is a question around how much of the price is also being driven by other factors, including FX. So you talk to some of the banks, SocGen, for example, thinks something like 30% of the price is really due to what's happening on the dollar. And that may be true if you look at what's happening with inventories around the world, right? You look at what's happening in the U.S., but even now, like I said, with China building as well. So there is a little bit of a disconnect between the micro and the macro. We've seen that in metals markets in the past.
And you mentioned tariffs. What about Friday? Did it change your thinking at all, your strategy at all, when Trump declared his tariff threat 100% on China?
I think it just reminded everybody that, your strategy is safe until the next tweet, right? But I think it's become a feature of these markets now where we, have to expect the unexpected in a sense. But I think it is something where people, again, I think have gotten a little complacent with the risk that's still out there. And I keep saying, everyone's sort of saying, okay, well, 2025, what do the tariffs look like by the end of it? But there may be more to come next year, right? If some of these goals are not achieved, if the trade deficit does not close, for example, could we see further measures next year? Right? And I think that's the issue, that it is still very much a movable feast. And I think the market, has gotten, again, a little bit complacent with that, really focused on the AI story, what's happening there to, the detriment of everything else.
Okay, so let's talk about the AI story. There's a headline coming through from the ASML, I think it's the CFO, saying the company's got all the materials it needs for the coming months. The hint there maybe being that it doesn't have the material beyond that because of potentially the tension between Europe, the United States and China. Does that have the potential to blow up the AI bubble? How nervous are you about what is happening in AI at the moment?
No, I think that's a really good point, as in these materials. I mean, this is part of the whole rare earths discussion and what's happening there, right? I mean, it's really China, U.S., to a degree Europe, but really China and the U.S. in an AI arms race as well, as much as anything else, right? We saw that with the DeepSeek moment earlier in the year, which, again, people have seemed to kind of move past. But I do think that if you look at how much of the investment that is going into AI, how much that is driving U.S. economic growth, which is what the rest of the world has really been reliant on for the last 4 years, in a sense. If that were to slow down, and by the way, we are already seeing a slowdown in year-on-year growth in data center manufacturing.
Yeah,
so despite all the numbers being thrown around, it's saying, well, okay, if that's starting to happen already, where does this go? And to me, the fact that you have a company, OpenAI, who's losing about $10 billion a year, going up to, they're going to go through $115 billion of cash burn in the next 3 years, saying, on the other hand, we're going to spend $10 trillion equivalent on new power plants, building 250 gigawatts by 2033. These numbers, in a sense, don't really add up.
If they don't add up, where do I look to them not to add? Which asset classes are most vulnerable to the maths not working?
Well, most vulnerable, I think, would be equities, I think, clearly.
Sure.
But I think
but
that's
in your world.
In our world, I think that, you would look at copper. I think there's been, a lot of demand that people are pricing in coming from there.
Yep.
Our CEO made the point yesterday, really, that, a lot of the core demand remains in sort of the more normal, air conditioners, refrigerators, whatever else. AI story is the future, but it's not yet the present, I think. And so you really need to see, okay, is that investment really going to materialize? But if it does come off, I think that's a real risk around some of these prices that are quite elevated. But that's why I think also where we come back to where we started, which is what gold and silver prices maybe are telling you.
All right, Saad, thanks for stopping by during Metals Week. Always good to have you round the desk. Saad Rahim, Trafigura's chief economist. We appreciate it. Well, coming up on the Daybook today, we've got plenty more Wall Street bank earnings to bring you. Then at 2:45 p.m. London time, a load of central bank speak. We've got the ECB's Rennes, Villeroy and the Bank of England's Breeden all speaking at the IIF meeting in DC. Then at 7 p.m. London time, we have the Fed releasing the Beige Book. And, of course, the US government shutdown rumbles on in the background. But it's payday for the military. They found a loophole to make that happen.
Yes, and with all of those in mind, let's get the final thoughts from Bloomberg's Valerie Teitel. Because, Valerie, I was wondering what's going to be most important in getting a steer without the regular data on the US economy today. We've got banks talking, we've got the Beige Book, we've got this pay packet for the military, but not others. That could take a political turn. What's your focus?
Look, I think the Beige Book will be important in the absence of data. Powell even mentioned it yesterday in the Q&A after his speech. But also the Wall Street earnings are going to be important. Yesterday, none of the banks reporting yesterday declared any big exposure to First Brands or Tricolor. We did have some warnings from Jamie Dimon on the fact that if you find one cockroach, maybe there are a few out there, others lurking. Now, perhaps from Morgan Stanley or Bank of America, they do unveil some more exposure to these bankruptcies. So I think that'll be a key to watch. Also watch loan loss provisions. That's the banks trying to shore up their balance sheet just in case further delinquencies rise. So I think those are the two key things for markets that are generally risk positive this morning.
Can I bring in Andrew Bailey? Talk a little bit about what he had to say yesterday. Interesting on the labour market, but also interesting on kind of the risks he sees out there.
Yeah, he again warned about AI valuations. He's been quite vocal in doing so, and that was something Powell was asked about yesterday but didn't entertain. He said he doesn't want to speak about specific assets and their valuations. He didn't really mention or want to get waded into that debate.
If he wasn't worried, he'd have just gone, no, I'm not worried about that, presumably. The fact that he didn't say anything, I thought about it. I was trying to think about that. He didn't want to be drawn on it, which kind of I think you can read some things into.
But it's very interesting. And I think you guys were just speaking about commodities there, the rare earth trade. Could these export controls that China has just announced in some way dent the AI trade moving forward and put at risk some of those valuations? Those are the two, I guess, key things that we're looking at today.
Valerie, thank you. Bloomberg's Valerie Teitel. On a programming note, the Canadian Prime Minister Mark Carney is the first guest on the Michelle Hussein Show, a new Bloomberg podcast. It launches on Friday. We will be beating the drum toward that on Friday and bring you some highlights, perhaps, ahead of its release. French markets really on a tear this morning, up by 2.4% on the CAC 40. The Pulse is next. This is Bloomberg.